time for the details on the money supply and what's going on with interest rates. I'm Nicole Petalides. We're on the floor of the New York Stock Exchange. It's our guest here, special guest Rebecca Walser, president of Walser Wealth Management, is here to give us a bigger picture on what's going on. You know, a lot of folks don't really focus on the M2 growth, the money supply, and it's an important part of the economy and what's been going on. So what is it that we need to know here today?
You know, Nicole, I think tomorrow, what Powell's going to say in Jackson Hole is going to be very telling. But to give you a frame of reference for this, we really are hitting a maturity wall. So about a third of our marketable securities, 25% of all securities are basically outstanding. All of our outstanding debt is being refinanced in 2025, $9.2 trillion. So when you see Trump come out and say, we need him to cut rates 300 basis points, 3%, it's because all of this debt that under the Biden administration, Yellen financed on the short end of the curve, 2 years or less, all of that is maturing completely and having to get refinanced. It doesn't even matter if Powell did cut 300 basis points. It would still be refinanced at a higher rate than when it was issued. Because remember, we had a Fed funds rate of 25 bips for 15 years almost. So what's happening is we are refinancing this debt at a much higher rate. We have so much more debt. Interest is creeping up to our second largest expense. It's already past Medicare and the Department of Defense or our military spending. So when you've got that kind of headwind facing you, you've got problems. The other thing is if you look at going back to the 1990s, there have been 9 times where the Fed has cut when the S&P 500 has been within 1% of its all-time high. We haven't really seen any kind of difference in those cuts and just regular cuts. So I think Powell is really weighing, what am I doing this for? Is it time to do this, or do I still need to preserve the dry powder for when the labor market is really problematic or when inflation is really problematic? Because right now, so far, even though we had a high PPI last week, it's a little bit still under the radar.
Well, late last year, there was a lot of worries about labor. I mean, we saw the Federal Open Market Committee talking more about the labor market, less about inflation. Now they were back to inflation, but that last labor print now brings it back to labor. So they do go back and forth. I mean, when I think about the money supply and refinancing the debt here, I mean, they've been doing this for eons, right? It's not a new story. And I understand why President Trump and his administration want lower rates so they can refinance at a better rate. But over the many, many decades, there were times that rates were much higher.
Yeah. The difference now, Nicole, is that the cumulative debt is $37 trillion and the interest expense is too much now of our federal budget.
Right.
And it's really becoming almost to a situation, I want to scare people or alarm people, but it's getting to the point of a potential debt spiral. Let me explain. The M2 money supply reached its highest in June of 2025, just in June this summer, right? So when you're looking at that money supply, it is annualized growth of 4.5%. Okay, that sounds great. That sounds like, okay, you're expanding your money supply, you're going to have a healthy economy, everything's going to be good. Except for the interest has almost tripled since 2020. So when your interest is almost tripling in less than 5 years and your money supply is only growing at an annualized 4.5%, which is expansive for what it has been in the last 3 years, that's the problem. We aren't keeping our money expansion up with the amount of the increase in the interest. And so what happens? Where do we get money? Where do we spend money? How do we keep financing this federal deficit?
You don't want them to keep printing money, right?
No, because what people don't understand, and that's the thing, is that there's so many people that want the Fed to be accommodative, but you understand when the Fed is accommodative, they're either really lowering the cost of capital, which means people are going to go out and borrow, which means the money supply is expanding, which is a good thing, but they're also printing, right? When they print, they're deflating the value of your existing dollar. If there's more dollars, that means the ones that existed before are worth less, not worthless, but worth less than they previously were. So either they can tax their way out of this problem or they can print their way out of this problem, and both are bad for the investor.
What happens to our economy in 6 months, 12 months? More.
Oh, what everyone is depending on right now, it's kind of the convergence of two things. We're entering this massive debt interest problem at the same time that we're meeting that with the fourth industrial revolution, the monetization of the fourth industrial revolution, when everyone is banking on. And that's why this market, I think, is almost priced to perfection. And you're seeing stocks get hammered when they're missing anything. Look at Walmart today. But what is happening is they're expecting that AI growth can supersede interest growth. And if that doesn't happen, that's a problem problem. The only problem with the AI growth, Nicole, is that they're expecting eventually, not right now, but they're expecting one person to be able to do the job of 1,000 people. So now you're talking about bringing the utility of human capital down so much that if all the profits are going to corporations, how are you and I and everyone else going to live? So there's problems.
That the AI hype was too much? I mean, I know we're in the AI revolution and we have trickling out and there's so much that can come from it and monetization and it helps productivity. And many people say we're just in the beginning of all this. Is the hype too much?
The hype isn't too much, but what is not being addressed head on and what no one will address head on and actually answer is what happens to human capital? If it's so efficient for AI, quantum computing, robotics, and the blockchain to have all these technologies that can do things so efficiently that we're not necessary, then what happens? If we're not working, if we're not contributing positively to GDP, what are we earning? What are we getting paid? What are we buying? How are we making money? This is a complete change economically, and as great as it sounds, no one's addressing that.
You do. When I asked you about stock picks and all that, sometimes you used to have stock picks, or some of them you were really evaluating the charts. Today you said gold is on your mind. Again, it's not the first time you like gold, and gold has had an incredible run up. I know it's pulled back over the last few weeks, but gold's still a good play. How far does it go up?
The fact that the dollar is getting debased, and if you have dollar debasement, people are investors for the long haul are looking to preserve true wealth. When you're looking to preserve true wealth, you've got to look right now at the blockchain, you've got to look at crypto, but you also have to look at the commodities. You have to look at gold, you have to look at silver, you have to.
Yeah, understood. And what am I leaving out as far as investors and what they should or shouldn't be doing? Because there's plenty of people who have a lot of money, and there's a lot of people who are fully invested. They have not gone to cash now.
Yeah, I think
a lot of people I talk to do not have cash now.
Well, I mean, we've seen it already. So if you haven't learned your lesson before, learn it now. AI is not going to be a straight up from A to B straight up. There's going to be gyrations. And we know if you look at the monetization of .com, you saw a pullback over 2 years. There was a .com crash. There's a crash for a reason. That's because valuations come in at this. And then when monetization actually happens and actual resorts come in, people see, oh, it's not quite that great. When you've got a Microsoft at a 60 PE, not forward PE, but current PE, when you've got NVIDIA at a 53, right now current PE, not forward PE, then it's so priced for perfection. If we don't monetize at that level, you're going to have a pullback. So
gold, the high was 3,534 a troy ounce. Do you see it going back to 3,500? Do you see it going to 4,000?
I see that gold is actually substantially undervalued for where it really is in the mix of what we've printed what we've grown our money supply to. Gold, because it hasn't been reevaluated, and that's one of the things the Trump administration is talking about. They're talking about reevaluating our gold reserves at the current troy ounce value, because that would make a huge substantial difference. But the truth is, we have so hyperinflated our money supply, Nicole, in the last 40 years that gold is substantially undervalued what it really should be traded at.
What about crypto and the BRIC nations trying to invent their own currency? But let's stick to crypto, something that people understand a little more. You have Bitcoin, you have stablecoin. Do you look to that as the dollar has moved out of favor a bit?
I mean, I am really thrilled that we are not in the United States looking at entering a central bank digital currency. That makes me very happy because I don't want the government to see all of my transactions. However, the fact that we're placing it in private corporations means private corporations, kind of like the banks, will be able to potentially debank us, right? And say, well, I'm not going to approve that transaction, or what do you need that for? And so it's a little bit scary to also have that level of control over stable coins with private corporations. So just so many changes. Investors, it's hard to keep up if you're not a professional. This is not the time to go passive or kind of, just set it and forget it. This is the time to really stay engaged and understand what's going on, and probably for professional management.
What do you think about all these leaders that run all these companies? Jensen Huang, Elon Musk, Tim Cook, you think about Mark Zuckerberg, you think about all these companies being run by these guys, and people often invest in stocks based on management or who they think has vision. Are any of those people inspirational to you, or you really are just looking at the nuts and bolts here?
I would say that the CEOs of the tech companies are really going to be the future presidents of countries. What I mean by that is countries are going to be less and less relevant as AI is implemented, and companies that run AI and run the world are going to be a lot more important. So we're going to get away from national boundaries and national sovereignty. It's going to be a lot more about the technology and the companies that are running them, and that's going to be a big change as well.
Wow.
It's just a whole change, a sea change over the next 5 years.
Get ready, folks.
Get ready.
Rebecca Walser of Walser Wealth Management. Always great to see you.
Thank you, Nicole.